Well, welcome. I'm David Phillips and the CEO of Estate Planning Specialist. And this is our third podcast in reference to the Build Back Better Act that was proposed by President Biden way back in November. And I encourage you to go back and watch the first two podcasts, especially episode 1, where we outlined some of the outrageous changes that were proposed by the House Ways and Means Committee at that time. Fortunately for all of us, especially our viewers that have estates of some size, most of the significant changes to estate planning were thrown out. We had a potential of the exclusion being reduced all the way to 3.5 million. We potentially could lose our step up in basis. Capital gains tax, we're going to go through the roof. There was just a lot of changes that were pretty scary. And one of them was the ineffectiveness or the abolition of trusts that we use, Dynasty trust, irrevocable trusts, that we have been using for years and years and years as valid estate planning tools and strategies. Well, all that's kind of been taken off the table. And so right now, today, we are kind of at a crossroad in reference to the Build Back Better Act. And we're going to talk about that today with our special guest, Rick Durfee, who is the founder and senior partner of the Durfee Law Group, one of the premier estate planning law firms in the country, and a good friend. And Rick and I have been on speaking engagements all throughout the country for well over 20 years now, and also we have a lot of common clients. Most of my clients are your clients as well. And then we're also joined by Todd Phillips, who is the president of our company, Estate Planning Specialist, and we're going to be doing some interchange here with them. I just want to talk, though, at first about the Build Back Better Act and where it is today. As if any of you have been following this, you'll notice, or you'll know that it has kind of reached a stumbling block with two senators, Democrat senators, that have blocked it. Kristen Sinema from here in Arizona. I can't remember if I voted for her or not. I guess it doesn't matter. Probably not, because she's Democrat and I'm Republican. But you know, she's blocked some of the proposals in that. And then also Joe Manchin. And those two have kind of put a blockade on this right now, and so it's kind of at a stalemate. First of all, it initially was a $3.5 trillion event, and then it was reduced to 1.5, and now it's even less than that. I'm not exactly sure what the price tag will be once the pieces of it are going to come through. I was speaking earlier today with Mark Skousen, who most of our viewers know is the editor and creator of Forecast and Strategies. And Mark's of the opinion that there's going to be some seepage on this, that we're going to see some tax reform that's going to come out of it, and maybe even that capital gains tax that was talked. Rick, opinion, what do you think?
Well, it is the nature of politicians to throw something outrageous on the table that they know will be rejected so that they can get other things passed that might meet with opposition, and then bring those same outrageous things up later. So today we're passing laws and having policies enacted that 20 years ago would have been unthinkable, and yet they're happening as a matter of course now. So all of these things will come back in one way or another at one time or another. So having a heads up, being prepared, seeing it coming, and taking appropriate action is highly to everyone's advantage.
Todd, do you have a thought on it?
I mean, it's the same as Rick. Yeah, you kind of just put the foot in the door and then squeak your way in a little bit later.
Well, good. Well, one of the things that we do know that has happened, regardless of what happens with this Build Back Better Act, is that the lifetime exclusion, federal exclusion, has actually increased this year. So 2022, the exclusion went from 11.7 million to little over $12 million. So that means that I can have an estate of 12 million, pass away, give it all to Todd, and no federal estate tax if I pass away. That's significant right now. And that'll actually go up again next year and until 2026. And the Tax Cut and Jobs Act that was passed with President Trump mandates that this is going to go back to around 6 million, maybe inflated to about 7 million. Who knows exactly where it's going to end up. Todd, when you and I are doing our estate plans, and I know Rick, you as well, we are taking this into consideration because it's law. It's there right now. They don't have to fix anything for that. And I think that's kind of why they backed off of the exclusion, because they know it's going to automatically happen. So what are your thoughts on that, Rick?
So the probability of that happening is high, and the law we have to plan for is the law on the books. And so we have to plan for that. If we don't plan for that, we're crazy, which means we have, again, this window of opportunity to take advantage of that lifetime exclusion at the high rate. Candidly, the estate tax law we have now is the most rational law we've had in my entire 3.5 decade of doing this.
Yeah.
You know, the stated policy objective.
2010 was better.
Oh, well,
yes,
it was better for the taxpayer.
Yeah.
But the stated policy purpose of the estate tax is to prevent us from having landed aristocracies where this mega wealth creates an uber class of ultra wealthy citizens. So they want to ding the super rich, and at 12 million and some change indexed to inflation, that's who it's going to hit. It's going to hit the super rich. The little ma and pa, the professional, the architects and CPAs and doctors and lawyers, they're going to not hit that generally, and if they do, it won't be by much. But at 6 million or 7 million, remember there was a day when if you had that much money, you could live on Gilligan's Island and be famous and never have to work because you're a millionaire. And today that means you have a good job and you own a house and have a little retirement set aside and you bought a life insurance policy. It's not hard to hit that if you're middle class and engaged in making money. So the opportunity we have now with that lifetime exclusion is to grandfather it in. So we take the gift now.
So we could actually then use the lifetime exclusion and give it away now with good direction from a professional and use it and have all of the appreciation of that gift be out of our estate forever.
Right, and there are ways to do that where you can, this is a cheesy saying, but have your cake and eat it too. You can give it away, but still have control over it, still make all the big decisions, and still protect it in your family for the family, and we can talk about that in more detail. But giving it away doesn't mean you're handing all the cash to your children if you do it correctly.
I just got back from a trip to France, which was very interesting, by the way, as far as all the testing and COVID testing and everything like that. It was bizarre. It really was. I felt like I'd been prodded and all the way through, and it was interesting. But anyway, we got there, and we went to a couple museums, and I learned about Dacian. I didn't know about it before, and you think I've been doing estate planning for 50 years, you'd think I would know it. Dacian is in France. If you have pretty much anything and you pass away, the government has claim to 40% of it. And there's no 11 million or $12 million exclusion. And so what a lot of folks are doing that are wealthy is they have a Van Gogh or they have a Picasso or one of the famous artists, and they give that to the Louvre or Museo d'Orsay or whatever, and they give it to them, and they get to basically that's their payment. It's called a Dacian payment that they give to the government, and it takes care of it. We're pretty far away from that right now, but we've been close to that. I remember when I first started, the exclusion was $60,000. Right. So we could go there. We could go there, but let's talk about the annual gift tax. So that actually has gone up for this year from $15,000 to $16,000. So we can, per person, couple $32,000 per child. Correct. So if I have 10 kids, grandkids. 10? Yeah, if I had 10. Well, I have 11 grandkids, and I know you have more than I do, right? Do you have more?
No, wait. Maybe. I think I have 13.
13, I have 11, and Todd has 6 of those, so thanks, Todd. But
appreciate your contribution there.
Yeah, well, and they're awful cute girls, but all girls, by the way. But anyway, the idea though is that I could gift all 11 of them $16,000. Me and Jane could too as well. Right. Yeah.
And I want to emphasize that does not mean giving those little children cash. That means having an appropriately crafted trust, and the gift goes into that trust and is used for a variety of things.
For future purposes, for future growth. Right? And you can have control over it way after you're gone. So, which brings me up to a recent statement that you made, Rick, that I think is, you said, gifting without, and I'm reading from this writing that you did. You said gifting without dynasty planning is like lighting money on fire and throwing it into your children's living room. It burns the money, your children's living space, and potentially your children. Don't do it. So tell me what you mean by that.
So it's just a fact that inherited money doesn't last. It gets burned. Roughly 57% makes it to generation 2, roughly 10% makes it to generation 3. Well, where does it go? It gets divided up, dissipated, distributed, and ultimately destroyed. And that process of destroying the wealth is often done through unhealthy, unproductive practices. It contributes significantly to divorce. I can't tell you how many clients I've had that they go, wow, I wanted a divorce for a long time. It wasn't worth it until now because you got money. And even though inherited assets can be excluded from the divorce, it means there's still more to go around in other ways. So in just handing people money, wealth is, and more often than not, a destructive force. It destroys the money, it destroys the people. So dynasty planning is a way to mitigate that. We can plan and structure the inheritance so we do what I call throttling the burn rate. How fast do you want to let them burn it? We can preserve and grow the principal. We can make it grow over multiple generations. And by the way, there are humongous tax incentives to do this. Instead of having the assets taxed at each and every generation, it can be structured so they're taxed once. We employ the exemption once, and then if it's structured properly, from generation to generation, that wealth passes transfer tax free and grows and compounds without having that tax hit every 20 or 25 years.
So if we just walk into this estate planning blindly, in other words, we don't plan, we die without a plan, we're just asking for trouble. I think that's what you're saying, right?
Well, even if we die with a plan, traditional estate planning, in fact, the traditional trust is a single-use throwaway instrument. What do?
You see those a lot.
We use it once, we avoid probate, yeehaw, and maybe we did some estate tax planning with an AB trust or whatever, and then what do? We distribute the money and we throw it away. And so then what happens to the money? well, 50%, well, 43% of it is destroyed in generation 2, and the rest is destroyed in generation 3.
Yeah, so one of the things that I'm going to recommend to our listeners today, or viewers, is that give us a call at our offices, and we have a system with Rick. We call the estate planning analysis. This is what the analysis looks like from our end. His staff and Rick will evaluate your current documents the way they are, where they're structured, make you recommendations on if they need to be fixed, and then give you a good track to run on. Not only the estate analysis, which gives you an estate plan on how to get from A to Z, achieving your goals and objectives. The fact of the matter is that if you have money, if you have wealth, God bless you, and make sure that it does right by your family. I think that's really what we're saying here. And even if you don't have a ton of wealth, I mean, we've been doing estates just recently that have been pretty gigantic. But we also have a lot of clients that are $2-3 million estates. And those are the ones that I really think we can help out a lot, because we can magnify that wealth and make sure that it not only they don't run out of money, but we also take, at least help out the multi-generations.
Right. When we get down to really what's going on here, people often are driven to the estate planning process by a concern for taxes or avoiding probate. But really, even with a so-called little estate, I only have $1 million, which again used to be a lot of money, but it's not anymore. Well, people are concerned, what's that going to do to my kids? Is it going to be a good thing or a bad thing when they get it? Is it going to last, or is it going to result in unhealthy life choices? And the legal planning and the associated investment and insurance and financial planning has a huge impact on that. Done correctly, it helps the family. Done incorrectly, it hurts the family.
Now, one of the things that we've been seeing a lot, Todd, I know that you've helped me with a lot of estate plans, is we've seen pretty sizable IRAs lately. And the big question mark is, should I convert it to a Roth IRA so that I can have tax-free income? And one of the ideas that we explain, and in our book that you and I wrote called The Bombshell Battle Plan, we actually wrote this specifically for Mark Skousen's subscribers. Remember back in Forecast and Strategy, but then we've offered it to, and you can get it through our website, this particular report. But in here we have an idea called the RMD leverage strategy. RMD meaning required minimum distributions, which now we know is at 72, that's when they begin. And they're right around start around 3.5%. And a $1 million IRA has to pay about almost $40,000 in required distributions. So you can kind of plan that. That's what your starting point is, and then it goes up from there annually. And a lot of times folks get into this, again, using the gifting concept. I've got the $16,000 now. They don't really need that money. That RMD is kind of a nuisance for them, for some folks. And even if it is, even if they need it to some degree, they like to leverage some of it. And so the required minimum distribution leverage strategy, RMD leverage strategy that we recommend, it basically allows you to take $1 and create $5 for future generations. Pretty cool. I've got a good example here. We have George and Sarah, and it's actually in the book on page, what do we have it on page, George and Sarah's on page 25 of the RMD leverage strategy, and I'll just kind of give you an idea on how this works. So George and Sarah have $1 million IRAs, let's say combined, and they're both 72. And the required distribution, as I said, is about $39,000. Net 25% tax bracket, so they end up netting about roughly $30,000. They could take that $30,000, and let's say let's say it was 32,000 because we have one kid. And I gift 16, Jane gets 16, Todd's my only child. Okay, I can gift that to him. Let's just say that's the situation. That $30,000 or $32,000 in my example would create well over $1.5 million in estate liquidity or increase. Yeah, tax-free, especially if we set it up through the proper trust documentation. And so that's a way in which we can augment our estate, make sure that our kids have assets. But furthermore, what if I have a pretty sizable IRA and I'm going to pass that IRA to my kids because we know the Secure Act now is a 10-year rule. They have to pay the taxes in 10 years. And the cool thing is with this strategy, they could use that money to pay the taxes. Not just to increase the estate, but to let the kids have the cash to pay the taxes. So anyway, make sure that you call us, go online, epmez.com, and order this, the Bombshell Battle Plan. And I think it has a lot of good material in there.
I'll just add, yes, they can use the money to pay the taxes, but it's really cool to do effective planning so there are no taxes. And then the tax-free money, they just get the tax-free money, which is not a bad strategy. I like helping clients figure out that we can take this taxable money or this taxable pot, and with effective planning over time, we can convert it into a tax-free or a non-tax pot. And that's a pretty powerful concept that we employ all the time.
Great. Okay. Well, let's talk about, we have, speaking of increases, tax increases possibly or whatever. Todd, we just got word that the best leveraged care solution, that's what we call it, asset-based care plan, long-term care plan, the best one out there, is going to have a rate increase. Tell us about that, Todd.
Yeah, I want to talk about that. Before I do that, I want to go back to what Rick was saying.
Okay.
And just, the market's down about 9.5% year to date, and we're here only in January. And it's hard when we're talking about life insurance, and when you die and you're 90 years old and your rate of return on your investment for the insurance based on the premiums is 5%, and I just made 30 or 40% in the stock market. Well, now we're down 10%, and people have short memories, they forget. This is a diversification tool, the life insurance. I think people don't consider that, but you know the amount that you're giving. You have it, it's hard-coded, you know the amount, and you know that it's all tax-free. And I think people forget that using it as a diversification tool against the other assets of their portfolio. And about the long-term care, it's another diversification hedge. We have so many risks in retirement, and we have taxes, which we're talking about, and then of course, long-term care, the ravaging expenses that we can have. Long-term care can wipe out a well-planned estate. I'm sure a lot of people have experience. We have a lot of clients, a lot of family, friends that have had to use long-term care. I was just talking to a client yesterday, and he just wanted to thank me, I'm not gonna give his name, but for getting the long-term care policy about 10 years ago. And his wife, they only put in $85,000 and have had $400,000 in benefits that they received. And he just said that was a real blessing because it's been tax-free and he's been able to get to it. The long-term care plan that it's been our number one plan, and it is the best in America. We can compare numbers and benefits. It's going to be going away. They've been an outlier. If you want to look it up, they can go to our website, ropltc.com, ropltc.com, and you can request an analysis or request a report. It's going to be going away here March. Well, not going away. They're going to be increasing the pricing 20% March 25th. And they have been an outlier for about a year, maybe two, compared to the competition. It's total outlier. And they
increased my prices by 20%.
They know they've been an outlier, but it's been with the state filing that they've been trying to fix it since September. And it's finally been able to get it approved by the state so that we know that March 25th, it's official. I don't think we're going to see a plan like this with this much benefits for money in as we have right now for a long time. I mean, I just don't see it. So it's a great time to get started, and you know, you're going to have to account for time to research it, to learn about it, us to run you illustrations, and you know, contemplate what you're getting, and then you got to get approval. We need the applications in and processed by the 25th. So it needs to be in by March 1st for us to have a shot at getting you in. I would start now with your request just to start understanding. It is the best plan, and the cool thing about it is, for one, it's a return of premium. So they are going to have an iteration that will have similar benefits, but it won't have the same return of premium. You won't be. What that means is, what money you put in, you'll be able to get out 5 years later, guaranteed. So whatever you put in 100,000, things change and you get inflation, or you got to go buy Bitcoin or something by then. You can take that money out and get the 100,000 back. But you can also have a fantastic long-term care benefit that could be some clients we're running, it's over 10 times what they put in by the time they're in their 90s with the inflation. And
so let me explain that. So if I transfer 100,000 into this, or 10,000 a year for 10 years, if I do that, or over 15 years, I can even do some ages you can do 15 years. Let's just say I do that, but let's just say I did a single sum of 100,000, and I'm 65. At age 80, how much is my 100,000 pool worth?
80,
right
probably
now?
600, 700.
Yeah, it's about 600. And so let's say it was 500, just for example, okay? And it's gonna go down 20%. What's it gonna be? 400,000.
Yeah.
So our point is, if you are at all considering transferring some money into one of these plans, return of premium long-term care, to take care of your potential care, now's the time to do it, because it's never going to be any less expensive, or you're going to be able to get more bang for your buck today than you will tomorrow after the 25th. And we knew this was coming. Like you said, they told us in September they were going to increase it, then they backed off because of some legislative issues in the state of Washington, and I think it's really critical that if this is something that's you've been thinking about, like you said, do the early research, but do not wait past the 25th.
So if the plan's in place before this deadline, you can put money in it later?
No, well,
Yeah.
you can apply before. You just have to apply. You don't have to have the funds in.
You don't have to do a single sum.
But you can put money in over time,
Right.
over 5 years or
Right.
10
Yeah.
years. Or whatever.
5,
But
10
if you're
years.
in now, and they have the increase, you do not have to. The increase will not affect you.
Right, it's locked. That's
locked
the whole
in
thing.
forever.
And unlike other long-term care policies, the pricing, the guarantees, everything is locked for life. They can't change
Yeah,
it.
so pretty cool. And I really believe that this is, we kind of stumbled on this about 15 years ago, not ROP, but the concept, because a lot of people were, I've got these assets I want to protect, and it's part of estate planning, and long-term care is, and so it's a very, and traditional long-term care has kind of gone by the wayside, and this is the new approach to it, and anyway, ROPLTC.com.
From the lawyer's chair, after people say, well, I want to protect my assets. What are the biggest risks? Divorce is number one. Long-term care is number two. And people don't, I want to protect my assets. Well, let's protect against the obvious things that are most likely to impair your wealth.
I gotta mention this one thing.
Okay.
They've talked about taking away, you mentioned it, the grantor defective provisions in the trust. That's something that if you had your trust in place prior to that legislation, it was going to be grandfathered in. Those trusts are so valuable.
Let me just say this. We found out about this together right around October, November.
Yes.
In our first podcast, we talked about it, right?
Yes.
And we had literally hundreds of calls of people saying, I got to do this before year end.
Yes.
Now it's kind of been pushed away for a second.
So don't wait. That's one thing. Don't wait. What people, call you in November and say, you can get this done before the end of the year, right? Well, yeah, you and everybody else that's on that bandwagon. So don't wait.
Somebody called me. I had somebody call me on the 30th. I was at the office and on December 30th and said, "Let's go. I'm ready to go." And sorry.
Yeah.
But I did tell them to make the gift. So they were able to make the gift.
You gotta act sooner rather than later. Get it grandfathered in. That kind of planning improves with age for many factors, not the least of which is the politicians are going to change the rules.
Get your estate analyzed and get
Do it now.
yeah, get in the queue and do it now. Any last comments, Todd, about the market, annuities, anything going on here? Well, no, I know, but you've been. This is kind of with this market going down like this, kind of got you on here.
I mean, it's down 9.5% as of today, year to date. I was preaching a lot in October, the last part of the year, that the market was overvalued. In fact, as of December 31st, the stock market in total was valued at 53.4 trillion, and that's 2.3 times our 23.2 trillion economy, U.S. economy. So 2.3 times the stock market was worth more than 2.3 times than our economy. At the peak in the .com crash, the market was only 1.4 times the total economy. So yes, because bond valuations are so low and interest rates are going up, lots of people are in bonds, forcing more people into the market, because that's the only place to go.
Right.
But it's kind of handcuffing people, pushing them into the same. I was preaching index annuities all last year, and talking to clients, and they locked in that money. Hopefully, it's not necessary, and the market's going to rebound.
Didn't you and Mark Skousen do a video
We did.
podcast?
Yes, we did do a podcast. Mark has incredible timing. When Mark says something, you should listen, because he's usually got pretty good timing.
Yeah, there's a really good story that you tell about his wife on annuities and in her IRA, and that was on that podcast, isn't it? On that podcast.
Yeah.
How
it's on the website. They can find it on the website.
On our website?
Yeah, on our website.
Okay, and what's our website? epmez.com. Okay, well, good. Well, thank you so much for joining us. We will keep you posted on the Build Back Better Act or variations thereof as it goes through these changes. Something will happen. Not exactly sure what it's going to look like. Most likely we'll see some increase in some taxes to get to the point to raise the revenue. Will it impact you? I don't know, but if you have an estate plan in place, the possibility, the probability of it affecting you as much as the person that's totally vulnerable aren't as good. So again, our recommendation is to get something rolling and give us a call. We'd love to help you. Thank you so much. Thanks, Rick.
Thanks.
Appreciate it. Melody normally is here with us. She wasn't able to make it today, and Todd, thank you so much for being here and being part of this. Appreciate it.
Thanks.
Peace out.